Hi there, welcome back to my channel Training Express. Today is session number 12. But before we talk about today's session, let's have a look at answer of the last session's question.
Question was, if a rent expense is due for payment in the amount of $500 but has not yet been paid, what would be the adjusting entry for this expense? Answer is, we will debit rent expense by $500 and we will credit the rent payable by $500.
Okay, so welcome back. Today is session number 12 and we will continue our discussion of the accounting cycle. The step which we were discussing last time, that was adjusting entries. So today we will continue the discussion of adjusting entries. So let's have a look at today's session and see how we are doing today.
Continue our discussion of the accounting cycle, and today we are going to look at part 2 of the adjusting entries. So in other words, today we will be again talking about basically step number 6, which is adjusting entries. So let's look at adjusting entries part number 2. Today we will be looking at deferrals or prepayments. Deferrals or prepayments can be classified as unearned revenue, prepaid expenses, and supplies. Let's look at what is unearned revenue. If customers pay us in advance of providing any services or delivering goods, also called customer deposits, is called unearned revenue. As we have not yet performed any services or delivered any goods, so it is treated as a liability initially. And when we perform services or deliver goods, then this liability is decreased and revenue is increased. Let's look at an example of unearned revenue. Customers paid us an advance of $3,000 on January 1 for 3 months of services. Services will be provided equally on a monthly basis. Explanation. Initially, it will be recorded as a liability of $3,000. As $3,000 is for 3 months, so it will be assumed that $1,000 of service revenue will be earned each month by the performance of services. Let's look at the journal entry here. Cash will be debit by $3,000 and unearned revenue will be credit by $3,000. Now let's see how we can record adjusting entries for that unearned revenue. As you know, we assumed that we will be performing $1,000 of services every month. So it means we will be earning $1,000 of revenue every month for 3 months. So let's look at our first adjusting entry on 31st of January. We will debit unearned revenue by $1,000 and we will credit service revenue by $1,000. In other words, we are decreasing our liability of unearned revenue by $1,000 and we are increasing our revenue by $1,000. Now let's post this journal entry. We will debit unearned revenue by $1,000 and we will credit service revenue by $1,000. Similarly, we will make the same journal entries on 28th of February. Unearned revenue debit by $1,000, service revenue credit by $1,000. It means we have earned another $1,000 of revenue during the month of February. So we will, post this journal entry, we will debit unearned revenue by $1,000 and service revenue will be credited by $1,000. Last month is the March. We performed services for another $1,000 in March, so we will earn another $1,000 of revenue. So the adjusting entry will be debit unearned revenue by $1,000 and credit service revenue by $1,000. Let's post this adjusting entry. Unearned revenue debit by $1,000 and service revenue credit by $1,000. Now try to look at the T accounts. Unearned revenue was initially credited by $3,000 on 1st of January, and at the end of each month of January, February and March, it was debit by $1,000 each. So you would see that the ending balance in unearned revenue is zero. So initially it was recorded as a liability, and at the end of every month this liability was decreased by $1,000. So by the end of 3 months, liability balance is zero. On the other hand, you will see service revenue ledger. So you will see every month it is being increased by $1,000, and by the end of March we have got a balance of $3,000 in our service revenue account. Now let's talk about prepaid expenses. When we pay in advance to our vendors or suppliers, it is called prepaid expenses. As we have paid in advance and haven't yet received any benefit of that payment, rather we will receive benefit in future. So we will be treating it as an asset initially, and as the benefit is received, asset will be decreased and relevant expense will be increased. Let's look at prepaid expense example. We paid insurance of 3 months in advance of $6,000 on January 1. Explanation. Initially, it will be recorded as an asset of $6,000. As $6,000 is for 3 months, so it will be assumed that $2,000 of insurance expense benefit will be enjoyed each month. Let's look at the journal entry. Prepaid insurance will be debited by $6,000 and cash will be credited by $6,000. Now let's see how we will record the adjusting entries for this prepaid insurance. As we have assumed that we will be enjoying the insurance benefit every month over a period of 3 months, so it means that we will be enjoying $2,000 of benefit every month. So what we will do every month, we will increase our expense and we will decrease our prepaid asset. So let's look at 31st of January. Insurance expense will be debited by $2,000. Prepaid insurance will be credited by $2,000. So let's post this journal entry. Insurance expense debit by $2,000 and prepaid insurance credit by $2,000 on 31st of January. Now 28th of February, same journal entry, insurance expense will be debit by $2,000 and prepaid insurance will be credited by $2,000. Let's post this adjusting entry here. Insurance expense debit by $2,000 on 28th of February and prepaid insurance credit by $2,000 on 28th of February. 31st of March, insurance expense debit by $2,000 and prepaid insurance credit by $2,000. Let's post this journal entry. On 31st of March, insurance expense debit by $2,000 on 31st of March and prepaid insurance credit by $2,000 on 31st of March. Now let's look at these three accounts of prepaid insurance and insurance expense. Look at the debit side of prepaid insurance and you will see that on 1st of January we debited $6,000 in this particular account. And when we look at the credit side here, you will see that every month it is being credited by $2,000. By the end of 31st of March, or you can say by the end of 3 months, there is no balance sitting in this particular account. Similarly, if we look at the insurance expense account, you will see that every month it is being debited by $2,000 and by the end of March we have got a total insurance expense of $6,000 in this particular account. Now let's look at supplies. Supplies or office supplies are needed and purchased quite regularly. But how much supplies are used during a specific period needs to be calculated. Now let's look at supplies example. Let's assume that the beginning balance of supplies on hand is $150. Business purchased supplies of $500 during the month of January. On January 31, business has supplies of $250 on hand. Question is there, how much supplies were used during the month of January? Explanation. Beginning balance is $150. We will add purchases of supplies during the month of January, $500. So total supplies available for use is $650. From this $650, we will minus the supplies on hand on January 31, which is $250. So this way we can calculate how much supplies were used during the month of January, and that is $400. We will record two journal entries. First one will be our normal journal entry for the purchase of supplies. So we will debit supplies by $500 and we will credit accounts payable by $500. Remember, these supplies will be treated initially as an asset. And now on 31st of January, we will record our adjusting entry for the usage of supplies during the month of January. So we will debit supplies expense by $400 and we will credit supplies asset by $400. Now let's look at our last topic of adjusting entries, depreciation. Depreciation is the allocation of depreciable cost of an asset over its useful life. Generally, we can call it a decrease in the value of a tangible asset over a period due to wear and tear, usage, obsolescence, etc. We will be looking at three depreciation methods over here. The first one is called straight line method. Second one is called declining balance method. And third one is called double declining balance method. Let's look at our first method, straight line method. This method is called a straight line method because the amount of depreciation stays same every accounting period. So just like a straight line. Now let's look at some of the terminologies which we will be using. Cost. This is the purchase price of the asset, including any duties, import duties, taxes, etc. Useful life. This is the life for which the asset will be useful for the business. Remember, this is just an estimate. Residual value. Value at the end of useful life. Again, this is just an estimate. The formula for straight line method is cost minus residual value or depreciable cost divided by useful life. Let's look at an example of depreciation. We have got computer of $1,200 and furniture and fixtures of $2,300 in our trial balance. Now let's assume the useful life of the computer is 3 years and that of furniture is 5 years. Estimated residual value of the computer is $100 and of furniture is $200. Let's use this formula to calculate the depreciation. So for computer, cost is $1,200 minus residual value is $100 and divided by 3 years. It will give us $367 of depreciation per annum, which means that it will be equal to roughly $31 per month. When we look at the furniture and fixture, we take the cost $2,300, we minus residual value of $200 and we divide it by 5 years, which is equal to $420 per annum. If we divide it by 12 months, it will be coming to $35 per month. So now the total depreciation for the month of January will be $66. Let's look at the detailed working of this depreciation over a period of 3 years. Computer asset, year 1, 2, 3, then you will see the cost, it stays the same. Depreciation amount, it also stays same. Now look at the accumulated depreciation column over here, column number 3. You will see the first year we have got $367 of accumulated depreciation because in year number 1 we have accumulated only $367 of depreciation. But when we move to year number 2, now we have got 2 years of depreciation. So 367 plus 367. And when we move on to third year, now we have accumulated 3 years of depreciation. So it is equal to $1,100. Look at the last column, net book value. Net book value is simply cost, column number 1, minus accumulated depreciation, column number 3. So at the end of first year, our net book value is $833. Next year, year number 2, 466, and third year it is equal to 100. So try to note this $100 is exactly the same amount which we estimated as residual value at the end of 3 years of useful life. Similarly, let's look at furniture and fixtures. We have got 5 years of useful life for furniture and fixtures. So year number 1, 2, 3, 4, and 5. Cost will stay same every year. Depreciation amount will also stay same every year. Accumulated depreciation will keep on accumulating every year. So first year it will be 420, next year it will be accumulated depreciation of 2 years, so 840, year number 3 1260, year number 4 1680, year number 5 2100. Last column is net book value, which is cost minus accumulated depreciation. So the first year net book value is 1880, second year is 1460, third year is 1040, fourth year is 620, and at the end of 5 years it is $200. So this $200 is actually the same estimated residual value at the end of 5 years. Now let's record the adjusting journal entry for depreciation. Depreciation expense will be debited by $66, and accumulated depreciation on computer will be credited by $31, and accumulated depreciation on furniture and fixture will be credited by $35. Let's look at what this accumulated depreciation account is. This is a contra account. Contra account means which would decrease the value of the associated account. In this case, accumulated depreciation is coming along the asset account. So it is called contra asset account. We use this account in order to comply with IFRS or GAAP to make accounting information and presentation more useful for the stakeholders. Now the question is when we will use the straight line method of depreciation. We can say that this method is used when the asset will be used at the same pace during the year. In other words, when the economic benefit will be obtained at the same pace throughout its useful life, then we can say that we should be using the straight line method. Let's look at the second method of depreciation, declining balance method. This method is called declining balance method because we calculate depreciation on the remaining net book value at the end of each accounting period. Note, we don't use the residual value here, as it is the stopping point where we stop to further calculate depreciation. This method is used when the asset will be used aggressively in earlier periods and slowly in the later period. Now let's look at how we can calculate depreciation for computer and furniture and fixture using the declining balance method. Let's look at computer. We will start with our cost in year number 1, $1,200. We are assuming a depreciation rate of 30%. So the depreciation will be $360. Accumulated depreciation, as it is first year, so it will be $360. And our ending net book value will be cost minus accumulated depreciation, $840. Let's move on to year number 2. Now here you will see that we will start with the ending book value of previous year, which will actually be a beginning book value of the current year, and that is $840. Now we will calculate 30% on this beginning book value. So it will be $252. So accumulated depreciation now will be prior year depreciation plus this year depreciation, and that will be 612. And our net book value at the end of the year will be cost minus accumulated depreciation, and that is equal to $588. Year number 3, we will start again with $588, that is the beginning book value. And now we will calculate depreciation at the rate of 30%, but it will not be the same amount. Here, because we assume that the useful life of the asset is 3 years, so at the end of 3 years we will stop. So we have assumed that the ending net book value or the residual value of the asset will be $100 at the end of 3 years. So now here we will take the balance as depreciation expense. So in other words, we assume that the residual value would be $100 at the end of 3 years. So it means the accumulated depreciation will be $1,100. So the difference will be treated as depreciation, which is $488. Similarly, let's look at the furniture and fixtures. We will start with cost year number 1, $2,300. Depreciation expense, we have assumed same rate, 30%, so $690. Accumulated depreciation first year will be same, and ending net book value will be $1,610. When we move on to year number 2, we calculate 30% on $1,610. Depreciation expense is $483. Accumulated depreciation is $1,173. Last year depreciation plus current year depreciation. And our ending net book value is $1,127. Similarly, in year number 3, we start with $1,127. We calculate 30%. Cumulative depreciation becomes $1,511, and ending net book value becomes $789. Year number 4, we start with $789, depreciation $237, accumulated depreciation $1,748, and ending net book value is equal to $552. Now this is last year. We start with $552. If we calculate 30%, the amount will be different. But as we have assumed that at the end of year number 5, our residual value will be 200. So that's why we have put a stop sign here. So residual value should be 200. So which means that accumulated depreciation should be 2100. And accordingly, our depreciation here will be a balancing amount of $352. Let's look at the adjusting journal entry for depreciation here. Depreciation expense here will be debited by 87.50. Accumulated depreciation on equipment will be $30. And accumulated depreciation on furniture and fixture will be 57.50. Now let's talk about our last method, double declining balance method. This method is like declining balance method because we calculate depreciation on the remaining net book value at the end of each accounting period, except that we charge double depreciation as compared to straight line depreciation method. Note, we don't use the residual value here as it is the stopping point where we stop to further calculate depreciation. This method is used when the asset will be used more aggressively in earlier periods and slowly in later periods, or sometimes it is recommended for tax purposes. Now, how can we calculate the depreciation rate in this particular method? It will be 2 divided by useful life of the asset. So for computer, we assumed a useful life of 3 years. So 2 divided by 3 is equal to 67%. Or you can see that it is just 2 times of the straight line method depreciation rate. Similarly, for furniture and fixtures, you will see it is 2 divided by 5 because we assumed 5 years useful life of the asset. So it is equal to 40%. Or if you look at the straight line method percentage and you multiply by 2, it is again equal to 40%. Now let's see how we can calculate depreciation using this method. You will see it's pretty much same as our last method, declining balance method. Year number 1, we will start with our cost $1,200. Depreciation expense at the rate of 67% is 804. Accumulated depreciation will be same, and our ending net book value will be cost minus accumulated depreciation is equal to $396. Year number 2, we will start with the 396. We will calculate depreciation on 396 at the rate of 67%. So it will be 265. Accumulated depreciation will be 1069, and our ending net book value will be $131. Year number 3, we will start with $131. Our residual value, which we assumed for computer, is $100. So we will stop here at the end of this useful life of 3 years. So we will put our residual value as $100, and our accumulated depreciation will be $1,100, and the balance to match will be $31. So in other words, here we cannot calculate exactly 67% of $131. Similarly, for furniture and fixtures, year number 1, we will start with cost $2,300. Depreciation expense, we calculated at 40%, so it will be $920. Accumulated depreciation first year will be same $920, and ending net book value will be $1,380. Year number 2, we will start again with the beginning net book value, which is $1,380, and we will calculate depreciation at the rate of 40%, $552. Accumulated depreciation here will be $1,472, and our ending net book value, cost minus accumulated depreciation, will be $828. Year number 3, we will start again with $828. We will calculate depreciation 40%, $331. Accumulated depreciation will be $1,803, and ending net book value will be $497. Year number 4, we will start again with $497. Depreciation will be $199. Accumulated depreciation $2,002, and ending net book value is equal to $298. Year number 5 will start with $298, and because this is the last year of our estimated useful life, so again here we will be calculating it in a different way. So if we calculate exactly 40%, it might not fit in over here. So what we will do, as we have assumed that our ending net book value at the end of 5 years or residual value should be $200. So you can see we have put there $200. So this way accumulated depreciation comes to 2100. So we will see what is the difference to balance. So we will be calculating $98 of depreciation in year number 5. Now let's record the adjusting journal entry for depreciation. Depreciation expense will be debit by $144 and accumulated depreciation on computer will be credited by $67 and accumulated depreciation for furniture and fixture will be credited by $77. Now let's look at our final worksheet. I have highlighted kind of in orange color the accounts which are affected during this lecture. For example, you can see here prepaid insurance initial balance is debit balance of $6,000. Then we made an adjustment of $2,000 for the month of January. So prepaid insurance is credited by $2,000 in the adjustment section. And at the bottom, insurance expense is debit by $2,000. And then accordingly, in the final adjusted trial balance, you can see prepaid insurance is $6,000 debit minus $2,000 credit is equal to $4,000 debit balance. Similarly, at the bottom, insurance expense $2,000 debit balance will become $2,000 as it is. Then we talked about unearned revenue. You will see in the middle of the worksheet unearned revenue. Initial balance was credit balance of $3,000. Then we made an adjusting entry. Unearned revenue was debit by $1,000 and service revenue was credited by $1,000. Then we talked about supplies expense. So initially supplies asset was debit by $500 and then supplies expense was debit by $400 and supplies asset was credited by $400. So you can see accordingly our final balance in the trial balance will be for supplies asset it will be $100 debit balance. And for supplies expense it will be $400 debit balance. Then we talked about accumulated depreciation, etc. So we calculated depreciation using the straight line method, declining balance method and double declining balance method. But for the sake of our trial balance or our financial statement, we will assume we are using a straight line method. So based upon the straight line method, we would assume we are making a journal entry here, adjusting entry. Depreciation expense in total will be debit by $144 and accumulated depreciation on computer will be credited by $67 and accumulated depreciation on furniture and fixture will be credited by $77. Now this way you would see that our final worksheet is done. Initially we had an unadjusted trial balance. Then we made various adjustments and based upon those adjustments, we finally prepared our adjusted trial balance. Now at the end of this session, as usual, let me ask you a question. What would be the journal entry to record depreciation of $150 on furniture and fixtures? For the answer, please wait for my next session, session number 30.
Okay, so this is the end of today's session. Let's see what we have learned today. Today we talked about prepaid expenses, we talked about unearned revenue, we talked about depreciation, we talked about different methods of calculating depreciation. So I hope you enjoyed today's session. Please stay tuned for more accounting lectures and don't forget to subscribe to my channel. Thanks a lot.